Off the coast of Micronesia, at the bottom of the ocean, lies a piece of limestone weighing thousands of kilograms. It sank over a century ago during a severe storm. Yet the locals on the nearby island of Yap still use it to buy things. To understand how a sunken rock functions as cash, we must rethink how money started. The classical economic story assumes early humans grew tired of bartering, trading a chicken for apples, and invented money. But anthropologists have found that pure item-for-item barter almost never happened within tight-knit communities. Early groups relied on complex webs of credit and social obligation. But as civilizations grew and people began trading with strangers, those personal obligations couldn't scale. They needed a standardized medium of exchange. At first, they leaned on items tied directly to human survival, like salt. Salt was essential for preserving food and surviving harsh environments, giving it a baseline physical utility everyone recognized. We still see the echoes of this system today. The Latin phrase for salt money, salarium, is the origin of the modern English word salary. While survival goods provided immediate value, they were often difficult to move or store. To build expansive trade networks, human groups transitioned to objects that combined physical durability with a strictly limited supply. Controlled scarcity is the strict law governing all functional money. If the supply of a money token isn't strictly limited, its value collapses instantly. The moment an object becomes too easy to acquire, people refuse to trade their actual labor for it. This presented early leaders with a bizarre psychological puzzle. They had to convince a farmer to hand over weeks of harvested crops in exchange for a shiny rock or a polished shell, trusting that the next person down the line would do exactly the same. The solution was to anchor these currencies in harsh physical realities. By choosing objects that required immense labor to mine, or selecting items geographically isolated from the trading zone, ancient societies engineered artificial limits on their money supply. Which brings us back to those massive limestone discs on the island of Yap, known as Rai Stones. These stones weren't naturally found on Yap. They had to be quarried 400 kilometers away, then transported across the open sea in outrigger canoes, a process requiring extreme physical labor and significant risk. The largest Rai stones were simply too heavy to hand over to someone during a daily trade. To solve this portability problem, the Yapese separated the physical object from the concept of ownership by inventing an oral ledger. Instead of moving the heavy stone, the community gathered and updated their communal memory of who owned it. A stone could change hands dozens of times while sitting quietly in the exact same spot. This is why the stone lost at sea remained valid. Everyone knew it existed, and everyone agreed on who owned it. Hundreds of years ago, this isolated island developed a functional, decentralized consensus network. It proved that money has always been a record of trust, existing independently of any specific physical asset. Across the globe, another system leveraged distance to engineer value. The Cowry shell is likely the longest-running and most widely circulated commodity currency in human history, powering markets across Africa, Asia, and Oceania. Cowries were mechanically perfect for commerce. They grew to a highly uniform size, making them easy to count rather than weigh. They were incredibly durable, and their complex biological structure made them virtually impossible to counterfeit. Their economic power came from geography. The Maldives Islands functioned as the de facto central bank of this global system. They held a near monopoly on harvesting the specific Moneta species of cowry, gathering whole shiploads from their shallow coral reefs and sending them outward. Because these shells originated in one specific oceanic region, their value naturally increased the further they traveled overland. In the interior regions of continents, thousands of miles from the coast, the cowry was incredibly scarce and therefore highly valuable. The cowry system maintained a stable economy for centuries because the total global supply of shells was strictly bottlenecked by the physical constraints and slow speeds of medieval maritime shipping. But relying on the physical world for scarcity carries a severe risk. If a society discovers a massive new deposit of a commodity, or a foreign entity rapidly injects a huge supply into the market, the entire economic system can buckle. In the 14th century, King Mansa Musa of Mali embarked on a pilgrimage to Mecca. He traveled with an entourage of thousands and hundreds of camels carrying an estimated 30,000 pounds of raw gold. In Cairo, Musa was notoriously generous, gifting so much gold that he completely flooded the local market. With supply skyrocketing, purchasing power crashed. Historical records track the precise fallout. The silver-to-gold exchange rate plummeted from 25 silver coins per gold coin to just 19. This event triggered over $1 billion in regional economic losses. It demonstrates that even a universally prized asset like gold lacks static built-in value. It's entirely captive to the basic laws of supply and demand. Centuries later, that exact same vulnerability was deliberately weaponized against the global Cowry economy. During the 18th century, European merchants realized West Africa heavily utilized the Cowry shell for trade. Using mechanized shipping fleets, the Europeans bypassed slow, traditional trade routes, harvesting and dumping more than 10 billion shells into the West African market. This chart tracks the resulting hyperinflation. As shell supply explodes vertically, purchasing power enters a freefall. An item once costing a handful of shells suddenly required thousands. The currency became physically unusable, its value vanished, and it was easily displaced by colonial paper money. Whether an economy runs on a 4-ton limestone wheel, a golden coin, or a digital ledger, the underlying math never changes. Money is a social agreement. It holds a society together only as long as the people trust the ledger, and the ledger maintains its scarcity.